Okay, good evening and assalamu alaikum to all of you, and welcome to all of you in day 3 of practice to pass session of paper F7, that is financial reporting. So, today is day 3. As for the commitment and the planning, we have to cover the key concepts of consolidation. In day 1 and day 2, we have already covered the key key reporting standards uh, relating to the final account, and the key we have done some practice of the key reporting standards relating to section A and section B. So it's highly recommended for all of you to please do practice repeatedly and try to memorize the key concepts of uh, key IFRSs that I have mentioned for this session, and at least do 30 to 35 MCQs on a daily basis from Kaplan or BPP kit. So it is again one of the most important point that I want to tell you is you have to maintain an average of 30 to 35 MCQs on a daily basis, because MCQs and OTQs will definitely make you pass in the examination, because of the fact that 60% of the paper will be based in will be covered in section A and section B. So section A and B is very important for the examination point of view, because it carries 60% marks. So all of you should score at least 70% marks in section A and B. Then it will be very easy for you to pass this exam. But if you are not getting 40 to 50% marks in section A and B, then it will be very hard and very difficult for you to pass the examination. So from the exam point of view of paper F7, it is highly recommended to repeat the concepts of IFRSs on a daily basis and try to solve maximum MCQs questions. For the final account, I have given you 5 questions, that is Chamberlain, and I have given you a Dugan question, Triage question, Sandown question, and Tomolit. So if you have done all the 5 questions, that is more than enough for you. So I have received some emails, and by tomorrow, inshallah, I'll be sending you the email with the constructive feedback about your script. So I think I want all of you to please focus on the key concepts of IFRS and final account. And secondly, try to solve the long questions on Excel or on the platform of ACCA rather than on your notebook. Do not practice long questions in the month of February on the notebook. That is highly recommended to solve the questions on Excel, or ideally it should be on the ACCA platform. Secondly, it is highly recommended for all of you to please try to do the practice in a limited time period. So with time constraint, you have to do the practice. Like I want to say that for MCQ, the time should be maximum 2 to 3 minutes. So if you are solving an MCQ in a period of 7 to 8 minutes, that it will be, I think, not you are not up to the mark according to the examination. For each mark in the examination, you have only 1.5 minutes. So if you are solving an MCQ, though, you have maximum 2 to 3 minutes. And for long questions, you have maximum, for a 20 marks question, you have maximum 30 minutes. So if you are able to solve the final account question in just 30 minutes, then you are perfect from the with respect to the examination situation. But if you are confident in the final account, but you are able to solve the question in 1 hour, then this is useless for you. So try to practice MCQs and try to do the practice on the Excel, and the time calculation is very important from the examination perspective at this stage. Secondly, do not do so much practice of long questions. That is again a very important point of view. If I have given you 5 questions in the final account, so I think the practice of 5 questions for the final account is more than enough. So if you are more worried about the final account, do one or more additional questions, but do not do a lot of long questions at this stage. Okay. So from today, we are going to start the consolidation area. For tomorrow, we have to cover the ratios. If you want me to discuss any standard that you feel that is important for you, you can write here in the chat box, then I can discuss it tomorrow. But the key point is, for the examination perspective, there are two important topics in which mostly the students are not performing well. The one is the final account, and the second one is the ratio analysis. And there is another topic, that is cash flow. For cash flow, I have already given you my WhatsApp number. I want all of you to join my WhatsApp group. I will give you the video of my cash flow, because cash flow, it is very least likely the examiner is going to ask questions in section C from the cash flow. So I have my video which I wanted to share with all of you on the WhatsApp group. Please join my WhatsApp group. I will share my video of relating the cash flow for 3 hours. So it's a 3 hours video for the cash flow. If you just go through that video, you will be perfect in the cash flow statement. But my recommendation is you have to focus more on final accounts, consolidation, IFRSs, and ratios. Cash flow is important, but the most important topic are IFRS, consolidation, ratios, and final accounts. Okay, there are some students who wanted me to discuss IS 33. Okay, for tomorrow, I'll discuss the EPS section. Then contract assets, I have already discussed contract assets in IFRS 15. X rights for the net assets. EPS, direct EPS, group disposal. Okay, the group disposal is again an area which we'll be discussing today. So there is no worries about the group disposal. Okay, so let's start with the first slide. Okay, the slide is relating to, you have to give the feedback of day 1 and day 2. So feedback is very important for the tutor, and the feedback is very important for the whatever it could be a positive or negative feedback, but it is highly recommended for all of you to please give your valuable feedback, so that uh, I might improve from your feedback, and it might be ACCA has done some more support to the students. But ACCA is incurring a lot of expense uh, for the students to increase their pass rates. But ACCA demands students valuable feedback. So please write something in the chat box about the feedback of day 1 and day 2. What you feel about the day 1 and day 2 uh, if you have attended both the sessions. Can you give your feedback so that I can start the session? I have received some feedbacks. of day 1 and day 2. And I want your honest feedback. It could be a positive or it might be a negative feedback, but we want, and the most important point that we want from you people is that uh, we want your feedback that whether this session is going to benefit you, whether it is uh, increasing your confidence on the final accounts, whether it clears your concepts. Okay, so let's start. Thank you so much for the feedback. So let's start the session. Now, I got motivated after seeing the feedbacks on the screen. So, so the format of the exam, we have section A, we have section B, and section C, and all questions are compulsory. This is a very important slide for all of you that the passing ratio of this paper is 50% at maximum. So you have to make sure that you should be in the 50% of the students who pass the exams. So try to avoid silly mistakes, try to do some practice, and focus on the key concepts of IFRS. So today is day 3, we are going to cover the consolidation, and in day 4, we'll be discussing the ratios topic. Okay, consolidation. So basically, these are some basic concepts that you should know in the topic consolidation. The first thing is the basic consolidation definition. You should know what is control, which might be asked in the MCQs or in section A. You should know the definition of parent company. You should know the definition of subsidiary company. What is control according to IFRS 10? What is control? So you should know the 3 characteristics of the control. So you should know the basic definition. You should know the concepts of unrealized profit. So it could be the candidate of section A, or it might be a long question in section C. You should know the treatment of current account with cash in transit and goods in transit. Then concept of cost of investments, how to calculate the cost of investment for the calculation of goodwill, and you should know how to how to deal other investments. You should know how to calculate NCI at acquisition. You should know the impact of fair valuation adjustments, how to calculate the net assets, and then goodwill calculation, then associate, then retained earnings, and then NCI. And last but not the least, it should be the balance sheet and the income statement. So you should be good enough that you can prepare the financial statements, consolidated balance sheet and income statement in hardly 25 to 30 minutes. So you have to do the practice according to the time limitations. Okay. So let's start from the first slide. Consolidated financial statements is one of the area that you should know. Is the consolidated financial statements mean the preparation of the financial statements of the group, assuming a single economic entity. So if we have 5 members in a group, parent S1, S2, S3, and S4, then These all should be considered as a single economic entity when we are preparing the consolidated financial statements. Group means parent company and its subsidiary companies. Do remember this point that there is no need that the parent and the subsidiary company works in the same organization, works in the same industry. So parent company or the subsidiary company might work in a different industries. Secondly, the consolidation is only the responsibility of the parent company. And in a group, there must be only one parent company. There cannot be more than one parent companies. The parent company is a company that controls the other companies. And the control means the power to direct the relevant activities. So this is the basic definition of the control, that the power to direct the relevant activities. Relevant activities means activities that influences the profits of the business. Now, associate company, an associate is an entity over which the investor has a significant influence. So the identification of the associate is very simple. When you have minority in the board of directors, so in a board of directors of 7 members, if you have one member, that means we have got the significant influence over that entity. If you have 2 members, that it means we have got the significant influence. If you have 3 members in the board, means we have a significant influence. But we have 4 members in the group, then it means that we can control that entity, because the decision making will be ruled by these 4 members. So the basic difference between the control and significant influence is that in a control you have the power to rule, but in a significant influence you only have the power to participate in the policy making process. So subsidiary should be consolidated and associate must be accounted for under equity method. Do remember this point, that associate will never be consolidated. The percentage required for the subsidiary will be 50% more ordinary shares, and the percentage for the associate is 20% or more. But the key point for the subsidiary is not percentage, it is control. If you have got enough shares in the company but you do not have the control, then it means this company is not your subsidiary. So the control is very important rather than number of shares. Secondly, for the associate company, there must be a significant influence. Mean you should have the power to participate in the policy making process. Then you can say this, that this company is your associate company. Significant influence is already discussed. Non-controlling interest is the portion of the equity in the subsidiary company other than the parent company. The equity in a subsidiary not attributable to the parent company according to IFRS 3. So these are the definitions of the relevant accounting standards that you should have to understand. Now, some very important points from the perspective of consolidation. The first one is all assets and liabilities of subsidiary should be measured at the fair value at acquisition. All the assets and the liabilities of the subsidiary company should be measured at the fair value. So there might be a fair valuation adjustment in property, plant and equipment. There might be a fair valuation adjustment in intangible assets. There might be a fair valuation adjustment in inventory. There might be a fair valuation adjustment in a liability. So if the value of the asset goes up, the fair value of the net assets goes up. But if the value of the liability increases, the fair value of the net assets decreases. Because net assets is calculated by deducting assets from the liabilities, by deducting liabilities from the assets. The second most important point is all intangible assets should be recognized for the purpose of consolidation. We have discussed in IS 38 that you cannot recognize the internally generated intangible assets. But for the purpose of consolidation, you can recognize all type of intangible assets for the purpose of consolidation. Contingent liabilities, according to IS 37, contingent liabilities should be disclosed in notes to the accounts. But for the purpose of consolidation, there must be a provision for all the contingent liabilities. So you have to record all the contingent liabilities. The consolidation should be on the basis of control and not on the basis of ownership. Means if I have got 80% shares in my subsidiary and the assets of the parent company is 100 and the assets of the subsidiary company is 100, so I cannot say this that the group share of asset is 180. That is 100 from the parent and 80 from the subsidiary, because we cannot do the consolidation on the basis of ownership. Consolidation must be on the basis of the control. Once you have got the control, then the 100% of assets of the and the liabilities of the subsidiary should be consolidated. So the group assets and liabilities should be reported at 100% rather than proportionate. So do remember this point. In consolidation, we never take, and we never do consolidation on the basis of ownership. We always take the consolidation. Once we got the control, we take the whole results of the subsidiary to be consolidated. Similar items should be merged. Similar items should be merged means all assets should be added, all liabilities should be added, all revenues should be added from the parent and subsidiary companies, all expenses should be added from the parent and subsidiary companies. So similar items should be merged, and intercompany balances should be cancelled. Intercompany balances means the receivable and the payable balances between the parent and the subsidiary company. If the parent company has to receive some amount from the subsidiary company and subsidiary company has to pay some amount to the parent company, so there must be an intercompany receivable and payable balances. These balances should be cancelled always for the purpose of consolidation. So intercompany, all type of transactions should be cancelled for the purpose of consolidation. So it might be an expense or income. It might be an expense of one company or income of another company. It might be receivable or payable of one or and second company, or it might be sales and cost of sales of one and second company. So all type of intercompany transactions should be eliminated for the purpose of consolidation. Now, what should be the basic steps that we should have to consider in performing the consolidation? Whenever you see the question from the consolidation, always start from that identify the date of the acquisition. So first of all, you have to identify at what date the parent company has got the control of the subsidiary company, and what is the reporting date for today. These two dates will tell you that you have to do the consolidation of 1 year or 2 year or 6 months or 2 months or 3 months, because whenever you take the profits of the subsidiary company for the purpose of consolidation, you have to proportionate the profits based on the time period. So the profit should be based on the time period. Like I have controlled the subsidiary for the last 6 months, then I can take the profits of the 6 months only rather than the whole year. So consolidation starts from the date of acquisition till the reporting date. Then you have to prepare the group structure. Group structure means, for example, if there are three companies, so you have to identify which one is the parent company, which one is the subsidiary, which one is the associate company, and you have to know this what will be the share of the group in the subsidiary and the share of NCI in the subsidiary. Then you should know the percentage of the investment of the parent company in the associate company, like it could be a 30% investment. So on a simple paper or pencil or scratch book on your platform, you can uh, just prepare the diagram of the group structure. Then area of the consolidation is very important. It could be the question from the balance sheet or it might be the question from the income statement. Then first of all, you have to read the questions and do all the adjustments. All the adjustments means adjustments which are not yet recorded. in the consolidation in the financial statements. Like sometimes examiners tells you that company has acquired a subsidiary and issued its shares in exchange of the shares of the subsidiary, but these shares has not yet been recorded by the parent company. So if the issue of shares for the acquisition purpose has not been recorded, then first of all you have to record all the adjustments. Then prepare net assets of the subsidiary at acquisition date and at reporting date. Then you are required to calculate the goodwill, then NCI, the consolidated reserves, and finally statement of financial position and statement of comprehensive income. Okay, there's a question. So repeat the point on intangible assets. Okay, for intangible assets, I'm repeating the point, and the point is, for the purpose of consolidation, all intangible assets should be recorded in the consolidated financial statements, irrespective whether it is internally generated or not. Where can I get the ACCA platform? ACCA, you just search or Google ACCA workstation, yeah, constructive response workstation. You will see the link, and you just have to click the link, and there will be a screen with Pearson view, and from that link you can see the platform of the ACCA. So let's start. Now here is a question for all of you. Please concentrate on this question. Which of the following will be treated as a subsidiary? So we have to identify which of the following is a subsidiary. The acquisition of 60% shares of Z company, equity share capital in March 2007. Z company's activities are significantly different from the rest of the parent group of companies. Like the parent company is doing the different business and subsidiary company is doing the different business. So whether I can consolidate this company if both are doing different business? I can or I cannot. We can consolidate. Yes, yes, very right. If we can consolidate the companies if they are working in different industries. The offer to acquire 70% of Unto company share capital on 1st November 2007. The negotiation were finally signed off during January 2008. So our errand is 31st December and the negotiation is still in progress. So this is actually an offer. We have not yet purchased the shares. Therefore, the Unto company is not the subsidiary company of the parent, but Zekron is the subsidiary. The acquisition of 45% of the Speed company on 31st December 2007, P company is able to appoint 3 out of 10 directors. 3 out of 10 means you only have the significant influence, but you do not have the power to control the company. So again, 3 is not a subsidiary company. So the answer is A. Very good. So there are some questions. Okay. Contingent liability should be deducted from the net assets of the subsidiary. Yes. All the contingent liabilities should be deducted and recorded for the purpose of consolidation. It is acquired after the year end and for 3 months it controls less than 50%. S is acquired. S is acquired after the year end and for 3 it controls less than 50%. Why 2 is not a subsidiary? Because for 2 there is an offer. The offer to acquire 70% shares. Basically, the parent company has just made an offer to the second company to purchase its shares, but the deal has not yet been finalized. Parent company has not yet purchased the shares. Therefore, 2 is the wrong answer. So the right answer is A. Next question for you. Petri owns 100% share capital of the following companies. The directors are unsure whether the investment should be consolidated. So the directors wanted to know that whether these should be consolidated or not. In which two of the following circumstances, which of the following circumstances would investment not? This is again a very important question from the examination point of view. That the question is saying that you have to identify the investment which is not be consolidated. So examiner always give you not in the capital letters. So do not ignore this not. So Petri has decided to sell its investment in Alpha as it is a loss making. The director believed its exclusion from the consolidation would be assist the user in predicting the group's future profits. Whether it should be removed from the consolidation or not. Yes or no? No. Great. So A should be consolidated. So there is no reason that if the subsidiary is loss making, you should eliminate that subsidiary because we have not yet sold. The company is still in the process of deciding to sell the alpha company. So you cannot show your positive results only. You have to show your negative result as well. Beta is a bank and its activity is so different from the engineering activities. So if the companies are doing different businesses, they should be consolidated. Delta is located in a country where the local accounting standards were compulsory and these are not compatible with the IFRS used by the rest of the group. Is it C is the right answer? Yes, C should also be consolidated. Why C should be consolidated? Because the companies are working in a different jurisdictions. They have different accounting standards. So there is no requirement to exclude the company if they are working with different accounting standards. Gamma is located in a country where the military coup has taken the place and the Petri has lost the control. Now this is the key point. Once you lost the control, means you lost your subsidiary. So once you lost the subsidiary, so there is no need to consolidate that subsidiary. So D is actually the right answer. So next question. Now unrealized profit is again one of the favorite area of the examiner. You should know the treatment on calculation of unrealized profit. So when you are doing the unrealized profit with the subsidiary or the parent, so the calculation for the unrealized profit will be profit in the transaction multiply by the percentage of stock still in warehouse. Like the question says that subsidiary company had sold 60% of the stock to outside the group, so adjustment should be made with 40%. Okay, so adjustment with the subsidiary and the parent company for the realized profit will be calculated with this formula. Profit multiplied by percentage of the stock, it's a stock actually, still in the warehouse. Now, when we are discussing with the associate, if the transaction was made with the associate, then the formula will be profit in the original transaction, then multiply by percentage of stock still in warehouse, then multiply by associate percentage. So you have to take the share of associate percentage of unrealized profit only for the purpose of consolidation. So at maximum there could be 6 cases for unrealized profit. I'm giving you just 1 minute to please prepare a double entry in all these 6 cases. Like when the parent company sold goods to the subsidiary company, what will be the double entry for the unrealized profit? Then when the subsidiary company sold goods to the parent company, what will be the double entry for unrealized profit? Okay. So I'm giving you just 1 minute to please do the double entry of unrealized profit in all the 6 cases. There's a question from the student side that in which cases subsidiary cannot be consolidated. Yes, we cannot consolidate the subsidiary if you lost the control. So losing the control is the only thing for the exclusion of the subsidiary company. So what will be the treatment? So the accounting treatment for the first parent to subsidiary should be retained earnings or consolidated reserves debit, very right, and credit should be stock. Very good. Then when the subsidiary company sold goods to the parent company, the accounting entry should be retained earnings and NCI both should be debited and crediting should be stock. Then what about if the parent company sold to the associate company? Are these reverse entries? Yes, you can say this are reverse entries, but for the purpose of consolidation, these are actually called adjusting entries. Do we need to know the double entry? It's very important to know the double entry of each and every single accounting concept because of the fact that being an accountant, you should know the impact of the transaction. And this is one of the reason that there are a number of students when they do their adjustment, their balance sheet are not balanced because of the fact that they do just a single impact and ignoring the second impact. But if you know the double entry, you can easily adjust the debit and credit impact, and your balance sheet will always be balanced. Now, if the parent company sold goods to the associate company, the accounting entry should be retained earnings debit and crediting will be investment in associate. Okay. Then if the subsidiary company sold goods to the associate company, the entry will be retained earnings and NCI debit and crediting will be the investment in associate. Then if the associate company is selling goods to the parent company, the entry should be retained earnings debit and stock credit. Then if the associate is selling to the subsidiary, the accounting entry will be same. So these are the 6 accounting entries, and you should know the calculation of unrealized profit. So moving towards the next slide, and a question for you. After the acquisition of the pen kit, after the acquisition, the pen kit sold goods to the spare. Penkit is the parent company actually, and Sphere is the subsidiary company. The 20 million Sphere had 1/5 of these goods still in the inventory. 1/5 means 20% of the stock is still in the warehouse. In March 2014, Penkit sold to Venter. Venter is actually an associate company. Okay. So if I if I give you the situation that Penkit has acquired 80% share in Sphere, and it's not 80%, Penkit has acquired 30% shares actually in Venture. So Penkit has acquired 80% shares in Sphere, and Penkit has acquired 30% shares in Venture. So Penkit sold goods to the vendor for 15 million, all of which are still in the inventory. All sales to the Sphere and the vendor had a markup of 25%. So you have to adjust these two entries. I'm giving you just 30 seconds. Okay, there are questions. Snapshot. Just please quickly take the snapshot. When the earning increases, it's a credit. There is no increase in earning. It is actually decreasing the profits of the business. Therefore, we have to debit the retained earnings. From associate to parent, debit retained earnings to who? The group or associate company. From associate to the parent, we have to debit the retained earnings because retained earnings of the group because uh, the profits of the associate company is also being transferred in the group retained earnings. So debit will be overall group retained earnings, and credit will be the stock. Should we debit the earnings by the percentage of control? Uh, should we debit the earnings? Only you have to apply the percentage when the subsidiary company is selling the goods to the parent or associate company. So if the subsidiary company is selling the goods, you have to use the retained earnings, and NCI you have to allocate the amount according to the percentages. So for 20 million, there is a markup of 125%, 25%. So it's a sales value. It should be divided by 25, multiplied by 25. We got the value of analyzed profit. So the 20 divided by 125 multiplied by 25, we got the value of 4 million. And only 1/5 is still in the inventory. So 1/5 means 20%. So 20% of 4 will be 0.8. So the accounting entry should be retained earnings debit and stock credit with 0.8. And when the parent company sold goods to the associate companies, so the accounting entry should be retained earnings debit and investment in associate credit. So what should be the amount? So 15 million is the value, sales value of the goods. So 15 divided by 125 multiplied by 25, we got the value of 3 million, and all the goods are still in the inventory. So the adjustment should be with 3 million into associate percentage. It should be 30%. So the adjustment should be with 0.9. 0.9. Because I have already mentioned that the percentage of in the associate company is 30%. So you have to take the 30% share of unrealized profit only. So 3 million is right, but you have to take the 30% of 3 million. Okay. So retained earnings should be debited and investment and associate credited. Very right. Now again, we have a question with the name Petula. So please solve the question. What will be the total inventory figures in the consolidated financial statement? So whenever you are doing the consolidated financial statement, the consolidated stock will be calculated as the stock of the parent plus stock of the subsidiary minus unrealized profit plus goods in transit, GIT. So this should be the formula for the calculation of group stock. So please, there's a question that where is it written that the vendor is associate? I'm telling you the vendor is associate because parent company has acquired 30% shares. So on the 30% shares you cannot control normally. So normally it should be considered as an associate company. Any other question? If no, please calculate the consolidated stock of Petula company. So your answer should be in the form of A, B, C, or D. The question is from where we know that it is 30%. 30% will be given to you, and this is the question in which I'm telling you the percentage is 30%. Okay, so let's start this question. The inventory of the parent company is actually 3250 plus the inventory of the subsidiary is 1940, and there is no unrealized profit transaction. I think Petula acquired 80% of the Sanka on 1st October 2005. At this date, some of the Sanka inventory had a carrying value of 600,000 but had a fair value of 800,000. Okay, so there is actually a fair valuation adjustment at the date of acquisition from 600,000 to 800,000. So there is a fair valuation adjustment of 100,000 in the value of inventory. By 31st December 2005, 70% of this inventory had been sold by the Sanka. So whatever inventory that the Sanka has been sold by the Sanka company to third parties. So there is no concept of unrealized profit here. But there is a fair valuation adjustment of this 30% portion. So it should be 30. There is no unrealized profit and there is no goods in transit. So the answer for this will be 3250 plus 1940 plus 30. 3250 plus 1940 plus 30. sorry, it's 200,000. So it should be 60. It should be 60. The value of A. So A is actually the right answer. I have wrongly calculated the value of 30. It is actually 60 because the fair valuation adjustment is for the 200,000, and 200,000 into 30%, we got the value of 60,000. Okay. So any problem in this question? So please ask it immediately. I think it's all clear. 30%. 30% is calculated from here because the company has sold 70% of the stock. So only 30% is still in the warehouse of the subsidiary company, for which we have done the fair valuation adjustment. Why we are using the fair valuation adjustment to calculate the inventory? Actually, fair valuation adjustments could be in any type of assets and any type of liability. So it's not compulsory that fair valuation can only be done in non-current assets. It could be done in current assets. It could be done in liability for the purpose of consolidation. How we calculate 60? 200,000 is the fair valuation adjustment, and 70% of this 200,000 is already sold. So only 30% is still in the warehouse. So by taking 30% of 200,000, we got the value of 60. Okay. So the formula for the inventory consolidated should be parent plus subsidiary minus unrealized profit plus goods in transit plus minus fair valuation if mentioned. So this is the formula that we always should have to use for the purpose of calculating the consolidated inventory. How could we know that there is unrealized profit or not? You can see here there is no buying selling between parent subsidiary company. So if there is no buying selling between the parent subsidiary company, so that means that there is no unrealized profit. It calculated for the 3 months only. Please correct this. It acquired on October, then it calculated for 3 months only. Please no. Do remember this point that the assets on the face of the balance sheet will never be proportionated based on the time period. Only we do the calculation on the basis of the time period in the income statement items only, not in the balance sheet items. If there is fair value, should be there unrealized profit or not? I didn't get your question. How do you know that? How did you know that this is an intercompany transaction? How did we know that this is an intercompany transaction? It's very simple that if the parent company is selling the goods to the subsidiary, or subsidiary company is selling goods to the parent company, then it means it's an intercompany transaction. Okay, the next topic is the current account adjustments. If there is an unrealized profit, then we will proportion it into months in the balance sheet. Do remember this point that the items in the balance sheet, that is assets and liabilities, will never be proportionated based on the time period. Time period will never be applied on assets and liabilities. Once you have purchased the asset, that it is your complete asset. Only the income statement items will be proportionated on the basis of time period. Like only income and expenses will be proportionated based on the time period. So do remember this point. So the current account adjustments. Current account adjustment means parent and subsidiary. So if there is an intercompany adjustment, you should have to cancel the current account adjustment. So there might be a debtor and the creditor. Debtor in the books of parent and creditor in the books of subsidiary. So all you need to do is to cancel out these two adjustments. There might be an investment in the book of parent company, means the parent company has given the loan to the subsidiary company, and a loan in the books of the subsidiary company. All you need to do is to cancel out these two from the accounts. There might be an interest receivable and interest payable. You have to just exclude these items. Inventories to be recorded at the lower of fair value or carrying value, right? So why do we increase the value while recording the acquisition? Inventory should be valued at the lower of net realizable value and carrying value. It's not fair value actually. Inventory should be valued at the lower of net realizable value and its carrying amount, that is cost. These valuation rule will be used when you are valuing the inventory in the individual financial statements. But for the purpose of consolidation, there could be a fair valuation adjustments in all type of assets and liabilities, irrespective of what the accounting standard is saying about that asset or liability, because we have already adjusted and prepared the financial statements of a subsidiary. So we have already incorporated all the values, but for the purpose of consolidation, there could be a fair valuation adjustments in which the values can be increased or it could be decreased. Okay. Stated at net realizable value. It was stated at net realizable value. Yes, it was already stated at lower of cost and net realizable value. But for the purpose of consolidation, you can do the fair valuation adjustments. Okay, there might be some dividend receivable and payable adjustments. But the question is, if the parent company has a data of 100 million and subsidiary company has got the creditor of 100 million. So what should be done? You have to cancel these two. But if the subsidiary company has already paid 30 million to the parent company, so the liability in the books of the subsidiary is 70, and this cash has not yet been received by the parent. This adjustment is called cash in transit. So if there is a cash in transit, do remember this, that the liability should be lower than the receivable value, and the difference between these two values should be the cash in transit, because the company who has to pay the amount has already paid the amount, but the company who has to receive the amount has not yet received the amount. So what the consolidation says about the cash in transit, it says that whenever there is a cash in transit, always record this cash, assuming it has been received by the parent, by debiting the cash and crediting the debtor's account. So when we credit the debtor's account, the value of the debtors will be equal to the value of the payable in the subsidiary account. Then you can cancel out these two transactions. Then it becomes current account adjustment. So all you need to do is to debit the cash account and crediting the debtor's account. And after crediting the debtor's account, these two values will be reconciled and you can cancel these two values. This should be the adjustment of cash in transit. This should be the adjustment of cash in transit. In the handout, it says that 5 questions are compulsory. Actually, I have copied the question from the past papers in which they have 5 questions. They might have 5 questions, but you are required to do at least 2 questions, and the three will be given to you at the end of the session today. So I will tell you the names of the 3 questions you should have to do before appearing the exam. Okay. So all you need to do is to practice 5 questions of final account, 5 questions of uh, consolidation, 5 questions of ratios, and only 1 or 2 questions of cash flow. That is more than enough for 40 marks. But focus on this portion that is related to 60 marks. Okay. So I think the cash in transit concept is cleared. Now, what about the goods in transit? Goods in transit means the company A has sold the goods to company B, means the parent has sold the goods to subsidiary company, but the subsidiary company has not yet received the amount of the goods. So the accounting entry in the balance sheet should be stock debit and account payable credit. And as we have purchased this stock from the parent company, then there should be the adjustment of unrealized profit in this stock. Okay. Okay. The cost of investments. Parent company. This is one of the most challenging part of the consolidation. One of the most challenging part of the consolidation to calculate the cost of the investment. The cost of investment could be in the form of cash, means parent company has acquired the shares of the subsidiary company and paid the amount in cash. So the accounting entry should be cost of investment debit and cash credit. It could be through share exchange. The accounting entry should be cost of investment debit, share capital, and share premium credit. Do remember this point that in the first paragraph, examiner can give you the hint that some of the cost of investment portions has not yet been recorded by the parent company. So first of all, you have to record all the unrecorded items. The deferred consideration should be recorded by debiting the cost of investment and crediting the deferred consideration. It should be recorded at the present value of the future cash flows. And we have already studied this, that whenever there is a present value, there should be an unwinding of discount. Contingent consideration must be measured at fair value. The accounting entry should be cost of investment debit, contingent consideration credit. And finally, loans and debentures. The accounting entry should be cost of investment debit and loan credit. So these are the 5 accounting entries which you might be asked by the examiner to prepare in the examination. So first of all, you have to record all the unrecorded transactions. Then you can start the question of consolidation. So here I am giving you the questions and in which you are required to calculate the cost of investment in Sphere company. Just 30 seconds is all you have. You can download today's slides and handouts from the handout section. And the 2 questions is given to you for the assignment purpose. So let's start. On 1st October, Pankit acquired 90 million shares. So you have to calculate all. You have to use 90 million for all the calculations. The acquisition was achieved through the share exchange of one share in the Pankit for every three shares in Sphere. So out of 90 shares, and for every three shares, company has going to issue one. Its new one share. So 1 upon 3 will be 30. Okay. At that date, the stock price of the Pankit and the Sphere shares are 4 and 2.5. So always remember this point. The share price of the subsidiary company will be given to you only to calculate the NCI, and the parent company share price will be given to you for the purpose of calculating the cost of investment. So this is the value of share exchange plus Pankit will pay 1.54 when after 1 year. 1.54 cash. 1.54 cash for each share acquired. 1.54 cash for each share acquired means Pankit is going to pay 90 million into 1.54 after 1 year. So what should be the amount? 90 million multiplied by 1.54. We got the value of 138.6. And you have to calculate the present value by multiplying with 909. There will be a value of 126. So by adding these two values, we got the value of the cost of investment. But you should know the accounting treatment or an accounting entry for these two. So the accounting entry for the share exchange will be cost of investment debit by 120, share capital credit by 30 million, and share premium credit by 90 million. And for this portion, the accounting entry will be cost of investment debit by 126 and deferred consideration credit by 126. And whenever there is a present value and deferred consideration, there should be an unwinding of discount. So the unwinding of discount of 126 will be 12.6. An unwinding of discount will always be charged in the retained earnings. So the accounting entry for the unwinding of discount should be retained earnings debit and deferred consideration credit. So the question is, why do we have to calculate the present value and how? Present value should be calculated according to IFRS 3, and it should be calculated using the formula of simple compound interest. Why 90,000 into 60% into 1 upon 3 not considered for the share exchange? Because 90 million is not the total shares of the company. If we have been given the total share, then we have to take 90,000 into 60%. But 90 million is the total value of the share that the company has already purchased. So you have to pay the amount equivalent to 90,000, or you have to pay the amount equal to the 90,000 into 60%. So you are not required to pay us the 60% portion. You have to pay the full amount. So if you have purchased 90 million shares, you have to pay for the 90 million shares. What is unwinding of discount? I have already explained the unwinding of discount in day 1 and day 2. So please refer to the videos of day 1 and day 2. Unwinding of discount, it is not depreciation. It is a finance cost which should be charged in the income statement under finance cost. Unwinding of discount will always be considered whenever we take the asset or liability at its present value. How do we get 30, 90, and 126? 30 is being calculated. 90 is given. 90 million is given here. 30 is 1 upon 3 because the company is going to give a single one share for every 3. 1 for 3 means 1 upon 3. And 126 is the present value of the future cash flows of 138.6. Why $4? Because the parent company is giving its shares to the subsidiary company. Therefore, we have to take the share price of the parent company rather than subsidiary company. Actually, we are purchasing the shares of subsidiary, but in exchange, we are giving the shares of the parent company. So, for the share exchange, we always use the share price of the parent company. Why not recording 30 million into 1.54? Why 90 million into 1.54? Now, 30 million is the value of the share exchange which the parent company is giving. And the cash consideration is a separate issue and the share exchange is a separate issue. So we are actually purchasing the wealth of the net asset of the subsidiary company and paying partly in cash and partly in shares. And for the share exchange, we are paying it in 30 million. And for the cash exchange, we have to pay 1.54 per share acquired. Per share acquired means we have to, per share acquired, you can see here, this is mentioned here, per share acquired means we have acquired 90 million shares. So you have to pay according to 90 million shares. How 126? 126 is the present value of the future cash flow. You can calculate using the discount rate at 10%. So COI is 120 plus 126. The cost of investment should be 120 and 126. Okay, this portion will be your assignment. This is quite similar to uh, question 1. Now, this will be used for the purpose of NCI. NCI acquisition can be given to you in the question, or you can calculate NCI acquisition by multiplying NCI shares in subsidiary multiply by share price of subsidiary. So NCI shares in subsidiary multiply by share price in subsidiary. So this should be the formula that we should have to use for the calculation of NCI acquisition. So can you calculate the NCI acquisition in this situation? Out of 9,000 shares, parent company has acquired 5,400 shares. So the remaining will be the rest with NCI. So the NCI shares will be 3,600 and the share price of each share of the subsidiary company is 1.5. So by multiplying 3,600 into 1.5, we got the value of 5,400. This is very right. Okay. So let's move on towards the next slide. Okay, fair valuation adjustment is a very important topic. Do remember this point that whenever the parent company has acquired subsidiary company, all its assets and liabilities, irrespective it is a non-current asset or current asset or a non-current liability or current liability, all these assets and liabilities should be measured at fair value. So there might be upward fair valuation adjustments or it could be a downward fair valuation adjustments at acquisition. So if there is an upward fair valuation adjustment, so there will be a downward adjustment at the reporting date. And when there is a downward adjustment, fair valuation adjustment, there will be an upward adjustment at the reporting date. Like if the value of the building goes up, there will be an excess depreciation, which decreases the profits. If the value goes down, there will be an increase. Okay. Okay. Net assets at acquisition and at reporting date. This is one of the most easiest technique to solve the consolidation perfectly. That is the net asset approach. For the net asset approach, you have to calculate the net asset at acquisition and at reporting. How we can calculate? You have to take the share capital and share premium of subsidiary. At both the dates, the amount will be same. You can take the share capital and share premium of the subsidiary. At both the dates, it will be same. Retained earnings should be different at these two dates, at acquisition and at reporting. So it should never be equivalent. Then other results could be changed. But when there is a fair valuation adjustment, it will be a connected with downward adjustment in at the reporting date. And whenever there is a downward adjustment, there will be an upward adjustment at the reporting date. Then, if there is an impairment loss, it should be reported in the income statement. And for the purpose of balance sheet, it should be reported in net assets. And if there is an unrealized profit can only be considered here when subsidiary sold to parent. The next is amortization or reversal, exit division or reversal, or anything related to the subsidiary should be added or subtracted here. Okay. So here we have got the formula for the goodwill. Cost of investment, we know how to calculate the cost of investment, then NCI, then fair value of net assets. By adding and subtracting these two values, we got the NCI at acquisition. So there might be questions in the examination when the examiner will tell you to calculate the NCI at acquisition. That means the goodwill at acquisition. That means the examiner is telling you to calculate the goodwill at the date of acquisition. So there is no need to deduct the impairment loss. So this is actually the goodwill at acquisition. But if the examiner is asking about the goodwill at the reporting, then you can deduct the impairment losses. If the answer of this goodwill is negative, then it will be considered as a gain from bargain purchase. And gain, or you can say this as a negative goodwill, or the gain from the bargain purchase will be charged and or recognized in the income statement as an income. The gain from the bargain purchase should be recorded as an income. So let's start this question. All of you are being given 1 minute. I'm giving you 1 minute to please calculate the amount of the goodwill in this question. Please calculate the amount of the goodwill in this question. Please calculate the amount of the goodwill. Okay, so let's start. Screenshot. Someone wants a screenshot of this slide. I think don't worry about these slides and videos. ACCA emails you the videos on a daily basis at the end of the session, and this video is already available on YouTube and Vimeo, so you can see if you miss something. Okay, I'm going to solve this question. The first thing is the cost of investment. The cost of investment for this question is 8,100. Then we have to add 2,700. It's a share exchange. It's a deferred consideration. And NCI should be reported at 5,400. Less fair value of net assets, which should be total of 14,800. So there will be a goodwill on the acquisition is 1,400. Okay, the first question is from where we have got this 8,100. So company has acquired 60% shares of the total 9,000 shares. So 9,000 into 60%, and company is given it's one share for every two shares. So the proportion is 1 upon 2, and the price of the each share of the parent company is 3. The price of each share of the parent company is 3 per share. That's shown here. So this is how we have calculated 8,100. What about 2,700? 2,700 is calculated through 9,000 into 60% shares we have acquired, and for each share company is going to pay 0.54, but after 1 year, so it should be 1.08 raised to the power minus 1. We got the value of 2,700. And NCI is calculated already, and fair value net asset is 14,800. We got the value of 1,400. Any confusions? Now there is a question relating to 14,800. How we have calculated 14,800? We take actually share capital, that is 9,000. Then we take retained earnings at the start of the year, 8,600, and we have to take first 6 months loss. For the year there is a loss of 3,000 as we have acquired in the mid of the year, so we have to take the 6 months loss. Then there is a downward revaluation of 2,500, and then finally there is a deferred tax asset of 1,200. This is mentioned here. So by adding these two or three, we got the value of 14,800. For 2,700 computation. 2,700 is the computation of, I can calculate it again, 9,000 into 60% shares we have acquired, and for each share company is going to pay 0.54, but after 1 year. So you have to take the cost of capital of 8%, that is 1.08 raised to power minus 1. So this is how you have calculated 2,700. Is that clear? Then we have NCI calculations. How we calculate NCI? NCI at acquisition, then post acquisition. D minus C. What is D minus C? You can see here D minus C. This is actually the net assets are reporting minus net assets at acquisition. So this is the most important slide, one of the most important slide for the consolidation, in which you have to put all the things and finally take the difference between these two. So NCI at acquisition into D minus C into NCI share. You can see here the NCI at acquisition that we already took in the goodwill, then post acquisition share of NCI into NCI percentage. These two should be added. We got the value of NCI. Should the deferred consideration be computed using the parent share? Obviously, based on the parent investment, we have to pay the amount in the future. So I'm giving you a challenging question for all of you. Please do solve this question in just 1 minute and reply your answer in the chat box. Okay, so let's start. You have to calculate the NCI. The formula is NCI at acquisition. An examiner is already given to you. The value of the NCI at acquisition is 1.1 million. So you can say it's 1100. Okay. Then at that date, the fair value. Then you have to. Now, there's a question from the student, what is D minus C? D minus C is actually nothing. D minus C reflects the share of post acquisition profits. At acquisition, at reporting. Okay. The net assets were equal to their carrying amount, except the building which had a fair value of 1.5 million above. So 1.5 million at both acquisition and reported will be added. And 30 years remaining useful life. So we have acquired it on 1st January and it's 31st December. So we have to book the depreciation of this 1500. So 1.5 million divided by 30. There will be a depreciation of, if it's 1500, so the depreciation will be 50. Okay. During the year to 31st December 2006, Merrick Company sold goods to Ronnie Company, giving rise to an unrealized profit in the. Merrick is actually a subsidiary company, and Ronnie is a parent company. So whenever the subsidiary company sold goods to the parent company, you have to incorporate unrealized profit here. So in the transaction, the examiner has already calculated the unrealized profit amount. So that is 550. And the profit for the year at the reporting date is 3200. I'm writing here because of lack of space. So at reporting, the D amount is 3200 minus 550 minus 50 plus 1500. Actually, the NCI share of the post acquisition profit, the net asset, the reporting rate is 4100, minus at acquisition is 1500. Into NCI share is 30%. So 4100 minus 1500, the value will be 2600 into 0.3. The total amount is 780. So 780 plus 1100, we got the value of D, 1880. Very good. There are some students who are, mashallah, performing so well. So I appreciate these their efforts. 1500 is deducted. Actually, this 1500 is the worth of the net assets at the start of the period. So we never take the net asset at the start. We always have to take the incremental amount from the acquisition till the reporting. So we have to follow. Actually, I am making all the students comfortable with this actually slide. Therefore, we have to calculate. You can even calculate the amount directly from 3200 and adjusting the analyzed profit and exit depreciation. That is again totally fine. But I want all of you to please try to memorize these slides, because when you'll be able to apply this slide, your 100% questions will be solved with 100% accuracy. So these are actually slides worth millions of dollars. You have no idea about the value of these slides. So it will the amount equivalent to millions of dollars, and I'm just giving you my uh, my fortune in a plate to all of you to try to memorize these formats. You have no idea how helpful these formats will be in the examination if you have got sound grip over these formats. 1500 minus 4500, why? Actually, 4100 minus 1500 reflects the increase in the net assets over the period from the date of acquisition till the reporting date. Therefore, we take the net assets at the reporting minus net asset at acquisition into NCA share. What is the retained earnings at acquisition? Retained earnings at acquisition is not being given to you, so we are assuming it as 0. Here is again a question for you. I'm giving you just quickly 10 seconds for you to please solve this question. You only have 10 seconds. 1, 2, 3, 4, 5, 6, 7, 8, 9, 9, 9. There are some A's and B's. Students are not interested in C and D, but there is a mixed answer. Some are interested in A and some are interested in B. But as the statistics shows that 50% result of the examination, I can see on the board that 50% students who are saying that it's A, 50% saying B, and 1% students or 2% students who are saying it's D or C. So let's start. It's about actually negative goodwill. And I've already told you that the negative goodwill should be considered as an income and it should be credited in P&L. And when we record this in the P&L, it will be transferred to the retained earnings automatically. So the answer actually A is only valid when the question says you that what will be the impact of negative goodwill in the balance sheet. So your answer will be right. But the question is what when the negative goodwill is confirmed, how it is then recognized. So it should be immediately charged in the income statement as an income, and through the income statement, it will be transferred in the retained earnings automatically. So the right answer is B because it's an income of the business. So I hope. Okay, associate. Now, how can we calculate or measure the investment in associate? So associate should be measured by adding the cost with the post acquisition profit in associate. So you have to take the post acquisition profit in associate into associate percentage. That is mentioned here. Minus impairment losses in associate minus dividend received. So this is the way through which we can calculate the investment in associate. So please try to understand and memorize this line or this formula. That is very important for you because there is a challenge question for you, and it will be your last question before the break. So I'm giving you just 1 minute to solve this question, and if 80% students will be able to answer it correctly, then I will give you the break. So it's a challenge for you. Okay, so let's start. There are some students who are uh, confused about A or D. Some are saying it's A, and some of the students are saying it's D. So let's solve the question. Investment in associate. So initially we measure at the cost of the investment. So Johnson has acquired 30% shares in Dream Company at a value of 1200. So 1200 is the cost of the investment plus share of the post acquisition profit. So the date of acquisition is 1st August and the year end is 31st March. So from the August till March, August, September, October, November, December, January, February, March. So it will be 8 months. So in the profit of 750, the post acquisition share of profit will be 8 upon 12 into our interest in the associate company is 30%. Then on 31st March, Dream associate company had 300,000 in its inventory, which it had bought from the Johnson. Means the parent company has sold goods to the associate company. So I have already told you about the accounting treatment. When the parent company sold goods to the associate company, the accounting entry will be retained earnings debit and investment in associate credit. So it should also be adjusted in the investment. That is 50. What I have calculated? I have calculated the 20% markup of this 300,000. Dream has not paid any dividend. Okay. On the assumption that Dream is an associate, what would be the carrying amount of the Dream? So this should be the carrying amount. So the answer should be 1800, 1200 plus 750 multiplied by 8 divided by 12 into 30% plus 1200 minus 50. The answer is C. So the answer is C. So I think I have to cancel the break because mostly the students are uh, on time portion. Mostly the students are interested in section option A and on D. Now, what's the mistake that we have done? We should have to include one more thing, that is unrealized profit only when parent sold to associate company or subsidiary sold to associate company. So these are actually the two situations which should have to be incorporated in the investment in associate. Instead of 8 months, I use 6 months. Yes, that is very important. These are actually called silly mistakes that we made in the examination. So you have to be very careful. And when distributing the profit, the time period is the key. That's why I have recommended you initially that first of all you have to know what is the date of acquisition and what is the reporting date. So these are the very useful tips that I'm giving to you. That first identify the date of acquisition and the reporting date. Okay, explain how 50 came. 50 is actually calculated from 300,000 as the gross profit markup is 20. So 20 upon 120, we got the value of 50. So 50 is actually the unrealized profit between the parent and the associate company. So this is how the examiner gave dodging to the students in MCQ section. So you have to be very careful in the 60% marks area, and this will inshallah will make you successful in the examination if you are good in the MCQs area. Now, uh, why I think we had made a mistake. We have to take 30%. Oh, so, I'm very sorry. Please try to. I also had done the silly mistake. It should be 15. 50 into 30%. Uh, Please correct your answers. I've done a mistake in the calculation of unrealized profit actually. 300,000 into 20 upon 120, we got the value of 50,000. And for the purpose of calculating the NCI, for the purpose of calculating the unrealized profit, we have to take the associate percentage portion of unrealized profit only. So I'm going to recalculate the answer. 1200 plus 750 into 8 divided by 12 into 30% plus 1200 minus 15. Oh my god, it's an A answer. So the right answer is A. So the students who are actually telling me about the A are right. So please accept the apology. And I think we should have to take a break. I also need a tea. So let's take a break for 10 minutes. No, 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 no. We don't have time. Only 5 minutes. Okay, welcome back. So let's start the session again. I hope you all are charged up for the next half an hour. So for the retained earnings purpose, this format is actually equivalent to $100 million, because mostly the students are confused in the retained earnings section when they're performing the consolidated balance sheet questions. They will not be able to balance the question because of the retained earnings. So this retained earning format will always give you the right answer. So starting from here, the retained earnings of the holding company means the parent company will always be taken in full. Then subsidiary, same approach, D minus C into group percentage. The share of associate profit that we have already calculated. Impairment loss of the associate should be deducted. Unrealized profit if the parent sold to the subsidiary should be considered here separately. Unrealized profit of fixed asset net of depreciation. Impairment losses if there is a proportionate approach should be placed here. And negative goodwill, which is the income of the business, should be considered here. Unwinding of discount is our expense, should be deducted from here. Changes in the contingent consideration. Sometimes the value of the contingent consideration increases, or sometime it might be decreases. So the changes should be adjusted from here. And any other gains or losses of the parent company, because the gains and losses of the subsidiary company should be dealt with in the net asset section. But if there's a gain or losses in the parent company, should be considered here. And the acquisition related cost should be deducted from here. So this is the final format which can give you always the right answer of the retained earnings. Okay. So let's test your knowledge. So you have been given the data about the Williams law. What would be the amount of the retained earnings in Williams law's consolidated statement of the financial position? So this is the question for you. Please try to attempt this question in just 1 minute. You only have 1 minute to solve this question. So first of all, we take the retained earnings of the parent company. Williams Solar is the parent company, has acquired 80% shares of the Zeta company. The retained earnings of the parent company is 200,000. Then net assets at acquisition, the net assets at reporting. It's at acquisition and at reporting. During the year ended 31st March 2015, Zeta purchased goods from the Williams Law. Zeta means subsidiary sold goods. Means unrealized profit should be adjusted here. Totaling 3,20,000. At 31st March 2015, one quarter of these goods were still in the inventory of the Zeta. Zeta purchase goods. I'm sorry. If it is a Zeta purchase good means parent company is selling. If the parent company is selling, then it will not be considered here. Zeta purchase goods. Zeta is not selling. Zeta has purchased the goods. Actually, goods from the Williams Law. At 31st March 2015, one quarter of these goods are still in the inventory of the Zeta. Williams Law applies the markup of 25% for all of its sales. So 3,20,000 markup of 25% means divided by 125 multiplied by 25. So what should be the amount? 320 multiplied by 25 divided by 125. So it will be 64. And 1/4 of these goods were still in the inventory. So 1/4 means 1 upon 4 of these will be 16 million. So 16 is the unrealized profit from the parent to the subsidiary company. But if the subsidiary company has sold the goods to the parent company, it should be adjusted in the net asset section. At 31st March 2015, the retained earnings of the Williamslow and the Zeta were 340 to 450 and 340. So the retained earnings of the Zeta at the date of acquisition is 200,000, and at the reporting date it's now 340,000. Okay. And the retained earnings of the parent company is 4,50,000. So the post acquisition period, there is an increase in the net asset of 1,40,000, and we have to take the 80% share of this 1,40,000. So what will be the amount? 140 into 0.8. The amount will be 1,12,000. So 4,50,000 plus subsidy share will be 1,12,000 plus 4,50,000 minus 16. So the right answer is D. So if you have any question about this, please ask it immediately. Okay. Do remember this point that whenever you are taking the subsidiary's profit, it should be according to the group share in the subsidiary. Okay. So go ahead. So these are some basic rules for the preparation of the balance sheet. The assets will be and liabilities should be consolidated on 100% basis. Liabilities should be consolidated 100% basis. Share capital and share premium will only be taken for the parent company only. And the retained earnings of the parent company will be taken in full. But for the subsidiary company, we have to take the share of post acquisition profit. Plus minus adjustment that we have discussed previously. And how to calculate the NCI is already discussed. Now this is the format for the balance sheet. Whenever you are preparing the balance sheet, in the asset side, first of all, we take non-current assets. In non-current asset, we always start from the property, plant, and equipment. Never incorporate any intangible asset into property, plant, and equipment. Do remember this point. So the property, plant, and equipment will be calculated at parent plus subsidiary plus minus revaluation plus minus reversal. This should be the value of the property, plant, and equipment. Parent plus subsidiary plus revaluation minus excess depreciation, downward revaluation, then reversal of depreciation. So these should be used when there is an upward revaluation. There should be a downward negative reversal entry, and when there is a downward revaluation, there will be a positive reversal of depreciation. Okay. Then we have goodwill. We know how to calculate the goodwill. Other investments should be measured according to IFRS 9, which could be at fair value through P&L, and it could be fair value through OCI. Any investment that is related to the subsidiary company, which is the intercompany balance, should be cancelled. Investment in associate should be calculated with this formula. Current assets. For the current asset, stock should be calculated with parent plus subsidiary plus minus fair value adjustment minus unrealized profit plus goods in transit. For debtors, it should be parent plus subsidiary minus current account adjustment, and that's it. Parent plus subsidiary minus current account adjustment. Cash, parent plus subsidiary plus cash in transit. Okay. In associate also it was same, right? Associate share of the profits. Yes, associate share of the profit will be taken with the share of the profits. But the percentage is actually low comparatively. Now, share capital and share premium of the parent company, holding company or the parent company should be reported on the face of the balance sheet. Do remember this point whenever you are preparing the balance sheet, there might be some unrecorded shares which all of you should have to record before the preparation of the balance sheet. Retained earnings is how we have calculated. NCI is calculated when we are preparing the non-con liabilities. There might be adjustments of deferred consideration and contingent consideration. Deferred consideration should be recorded at the present value. Then there must be an adjustment of unwinding a discount. And for the contingent consideration, there might be a changes in the fair value, which could be a downward or upward. Current liability will be same, parent plus subsidiary minus current account adjustment plus goods in transit. Because whenever there is a goods in transit, there will be an increase in the liability. And then subsequently it will be cancelled through current account adjustments. In the current account, we deduct the cash in transit. Yes, we have to deduct the cash in transit adjustment in the current account. You can see here the parent plus subsidiary. So actually the cash in transit is also related to the current account balance. Therefore, I am including this cash in transit adjustment under current account. NCI. This is again a very important point. NCI can be calculated at the fair value and NCI can be calculated at the proportionate share. So examiner can ask you to calculate the NCI at the proportionate share. The formula is very simple. Net assets at acquisition that we have already calculated into NCI share. This is how we calculate the NCI at acquisition. But in case of the fair value, we use the formula of NCI shares in subsidiary multiply by share price of subsidiary. So mostly and almost 100% of the question in the examination kit is available on the fair value, but examiner can ask you the question relating to the proportionate share. This is the adjustment for the revaluation. Examiner can ask you sometimes for the calculation of the revaluation. So the revaluation of the parent company should be incorporated here. Revaluation of the subsidiary company should only be reported on the balance sheet when the revaluation was done in the post acquisition period. Means after the acquisition of the subsidiary. Then we can use the revaluation into holding percentage. But if the revaluation was of the subsidiary asset was done at the date of acquisition, then it should be incorporated in the calculation of goodwill. Okay. Here is a question for you, all of you to calculate. What is the total equity attributable to the owners of the Anita company. Total equity attributable to the owners means you have to calculate the share capital plus retained earnings. And you are not required to calculate NCI. Please calculate the values. I'm giving you just 1 minute. On 1st October 2005, Anita company purchased 750,000 of Benita company 100,000 shares. So they have acquired actually 75% shares. When the retained earnings was 90,000 actually. And on 30th September 2007, after 2 years, extracts are available here. So on the face of the balance sheet, you should only have to report the share capital of the parent company. And when we are calculating the retained earnings, we can take the retained earnings of the parent company 100% and subsidiary only post acquisition. So it should be 150 minus 90 into 75%. So the right answer is B or D. I think it's B. Yes, B is the right answer. So moving on towards the next slides. So these are the slides for you to read. I'm just skipping. Okay, from the consolidated income statement perspective, you have to take the consolidation of the income statement very seriously because the most important point in the consolidation of the income statement is the income statement will be consolidated for the controlling period. And if the controlling period is less than 12 months, then you should have to proportionate all the results of the subsidiary company. So this is the most important point in consolidation. So how to calculate the revenue in the income statement? The revenue of the parent company plus the revenue of the subsidiary company. Multiply by time period if it is required. The time period will be required when the controlling period is less than 12 months. So it could be the factor of 2 by 12, 6 by 12, 8 by 12, 9 by 12. If the time period in the controlling period is more than 12 months or 12 months, then you can simply add the sales revenue of parent plus subsidiary minus intercompany revenue should be deducted. So this is very simple to calculate the revenue of the parent company. Then cost of goods sold, holding company plus subsidiary company, same time period if required, minus intercompany sales, similar items, plus analyzed profit. We have already know how to calculate the analyzed profit, plus excess depreciation. Excess depreciation is used when there is an upward revaluation, minus reversal of depreciation when there is a downward revaluation. So for upward revaluation, we use the excess depreciation, it should be added, and when there is a downward revaluation, there will be a reversal in the depreciation. So this is how we calculate the gross profit. Do remember this point that the excess depreciation and the reversal of depreciation will be charged in cost of goods sold. Then for operating expense, holding company plus subsidiary company plus impairment losses. Impairment losses will be charged in the operating expenses or it could be reported separately. Incomes, holding plus subsidiary minus intercompany income. Any type of income that the parent company is going to receive from the subsidiary or subsidiary company from the parent company should be deducted from here. Negative goodwill is our income, it should be added here. Share of associate profit, net of impairment loss. We have already learned how to calculate this value. Changes in the contingent consideration, if it is occurred, then it should be reported as a gain or loss. Gains and losses on fair value through P&L. Do remember this point, IFRS 9 says it could be a fair value through P&L or fair value through OCI. Fair value through OCI gains will be reported here. And fair value through P&L gains and losses should be reported here. Finance cost is very important. Holding plus subsidiary minus intercompany finance cost if it is given. Plus unwinding of discount. Unwinding of discount is used in the calculation of deferred consideration. So this is how we come up with the profit before tax. Then we deduct tax expense, the answer will be the profit for the year. So these are the formats that we use for consolidation, balance sheet and income statement. Believe me, if you will be able to memorize these formats, I can guarantee you your answer will be 90% to 95% correct in the examination. Secondly, when we got the profit for the year, this profit should be split between the group and NCI. Then we add other comprehensive incomes and we got the total comprehensive income. So you can see here in the other comprehensive income section, we have only two items to be reported in OCI. The first one is revaluation gain and the second one is gain or loss on IFRS 9 investment which are held at fair value through OCI. Now the tax calculation is holding plus subsidiary simply. But again, I'm repeating the point, if the controlling period is less than 12 months, then each and every single component of the subsidiary company should be proportionated. Now the questions from the student side are, is the excess depreciation when an asset is revalued below its carrying amount? Excess depreciation when the asset is valued below its carrying amount? No. Excess depreciation is calculated when the asset's fair value is above its carrying amount. and downward revaluation, there will be a reversal of depreciation. So when the assets carrying amount value, the assets fair value is below its carrying amount, then there will be a downward revaluation, and in that case, you have to do the reversal of depreciation. Tax is only for the holding company. No, I have already mentioned. Explain the previous example, please. Actually, there is only 3 minutes left, so it is highly requested to all of you to please join my WhatsApp group, and we can discuss till the examination date a lot of your issues. How one can memorize in such a short span of time if he or she is not good in cramming. I can say this, that if there is a shortage of the time, you can just write the format of all the balance sheets, goodwill, retained earnings, NCI. There are hardly 3 to 4 or 5 formats in each area. Just write it down before sleeping. So I think in a day or two you will be perfect in the format. Explain the finance cost intercompany. Intercompany finance cost means the finance cost which the subsidiary company is paying to the parent company, or the finance cost which the parent company is paying to the subsidiary company. Okay, my contact number is mentioned the here. Okay, so I am moving towards the next slide. So this is the profit distribution slide, that we have to distribute our profit into group and NCI, and also the total comprehensive income. Then how to calculate the NCI? So this is the format through which we can calculate the NCI. Suppose if the profit for the year is 100 million and we have calculated the NCI from this figure, that is 20. So the balancing figure will be the share of the profit for the owners. Then this will be your assignment. Yes, ready for the examination question. Now, I want all of you to solve these questions. Now, in the handout section, there is a day 3 handout. You can see here. So these are the 2 questions. One is related to the balance sheet, complete question with parent, subsidiary, and associate, 3 companies. So this is the question. You can download it from the handout section. So you have to solve this question by tomorrow, and please email me the question so that I can check your questions and reply with the constructive remarks. It's very important that you should know your mistakes. Then it's a question relating the income statement that includes parent, subsidiary, and associate, so that you should have a grip on all these aspects. So these are 2 comprehensive questions, and 3 more questions which I will be giving to you tomorrow. So if you are having some problems in day 1, 2, and 3, you can discuss it on the WhatsApp group, or simultaneously you can email me, or you can we can discuss in tomorrow's feedback, tomorrow's session. For tomorrow, we'll be discussing IS 33 EPS and consolidation disposal area, and finally we have to cover the ratios area. Okay, haven't gotten the feedback on my last assignment. You'll soon receive the feedback, so you don't have to worry about. My uh, my number will be shared to you by the department personnels. That is 0332 213 4466. Please share my number on the screen. And till then, thank you very much. Inshallah, we'll be starting from tomorrow. Thank you very much. If you have any question, please do ask it on the WhatsApp. Allah Hafiz.